You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, coming up on today's program, we'll give you a recap of what happened in 2018, and we'll look ahead to 2019. 844-305-7800 is the number. How was the year for you? How did your investment portfolio perform? How did your retirement portfolio do? Were you closer to your financial goals, meeting them, meeting your expectations this year versus previous years? What went right? What went wrong? And how do I improve? It's time for self-reflection. I guess that's what I like the best about the end of each year, is that we can reflect and think about what exactly happened this past year. What went right? What went wrong? What changes do we need to make in order to improve? So these are the things that I want you to think about as you begin to look ahead to 2019. Now, in terms of New Year's resolutions, I'm not a big believer in them, just because I don't need the change of a calendar year to make a firm choice and decision as to how I want to improve my life and my habits. I don't need a change of year in order to do that. I can do that any time. And in fact, I don't have to wait to a brand new year, and you shouldn't have to wait to a brand new year to make radical changes, to make radical improvements in your life, whether that's investment, whether that's personal life, whatever, relationships, savings goals, spending more time with your family. These are things that you should be doing, not just in terms of making resolutions at the start of a year, but making resolutions throughout the year, and being committed, not just at the beginning of each year and then failing, but being committed throughout the year. So these are philosophical things that I'm sharing with you that will hopefully help you to improve. Now, in terms of market performance, if we take a look at the big picture view of major asset classes across the world in 2018, we saw most asset classes decline, including U.S. stocks, which as a group for the year declined just a little over 6%. Ticker symbol SCHB is the Schwab U.S. Broad Market ETF. And that one tracks not just the S&P 500 stocks, but we also have mid-cap as well as small-cap companies in that particular ETF. So that's a big picture, broad view of what happened in U.S. stocks. Down a nudge over 6%. Not a disaster. These are modest losses. Now, if we look at it from, of course, the mid-2018 mid-year peak, obviously it is a pretty big drop, right? We're looking at a decline near 20% for most of the major indexes, like the NASDAQ, of course, tech-heavy. But that, of course, is a pretty steep fall in a very quick amount of time. We'll talk more a little bit about that later. What 2019 perhaps portends, portends, P-O-R-T-E-N-D-S, for us and what we can do to prepare for that. In terms of other areas around the world, international stocks as a group were not good performers, down about 15%. And then emerging markets, about the same, VWO. Now, for some of our new listeners not aware of the differences between international markets and emerging markets, sometimes there's confusion because they seem a lot like each other, but they're really not. And emerging markets refers to countries which are still in the process of having their economies become established and developed. So they're not categorized, for example, as G7 nations, but nevertheless they're important because they're in the process of hopefully graduating to that point. And we've got many important economies in the emerging world, for example, Brazil and China, as well as Russia and India. I mean, these are mega emerging market countries that you're going to get exposure to in an ETF like ticker symbol VWO, you will not get exposure to these countries in something like ticker symbol VEA. VEA, of course, tracks developed international stocks. So, as the name indicates, these are countries that are established. They're developed economies. They are places like Canada, the U.S., France, the United Kingdom, Australia. These are established countries with established economies that are classified by the indexers as developed nations. So that's just a little bit of a difference there. But as a group, both groups in 2018, emerging markets as well as international stocks, both performed about the same, down around 15% on the year. Now, in terms of other major asset classes, commodities as a group were weak performers, down about 11.5%. Ticker symbol USCI is a broad basket of 17 different commodity futures contracts and that are chosen and selected based on various factors and then given an equal weighting. So that particular group, of course, was weighed down by the trouble in energy commodities, particularly oil. We saw a collapse in crude oil prices, of course, gasoline prices. Great for consumers, not so great for oil producers, as well as the energy sector, which was definitely one of the weakest performers in the S&P 500 in 2018. Now, in terms of other major asset classes, we've already talked about stocks. We just talked about commodities. Can anybody think of any other major asset classes that we've missed? Yeah? Well, what about bonds and what about real estate? Those are two major asset classes. And those two asset classes were actually the outperformers in 2018. Total U.S. bond market down about 0.25% on the year, ticker symbol BND. And then global real stocks, REET, down almost 5% on the year. And those two areas were the, you might say, bright spots of 2018. But everywhere else in terms of equities around the globe were negative. So the question, and we'll talk about this later, we'll be looking ahead to 2019. What is ahead for 2019? What should we expect? And by the way, what happened to the once reliable bull market? I'm going to share some words of wisdom with you on today's program from some legendary investors who had a lot to say about market bottoms as well as bull and bear markets and things that I think will help us to understand what to expect looking ahead and how we can prepare for that. So how has your investment portfolio again done in 2018? How did you do? Did you gamble your life savings away? Did you take more risks than you thought you wanted to take? What did you do right? What did you do wrong? And let's talk about it. 844-305-7800 is the number. You can also tweet the program at Index Show is where you find me on Twitter. And I'll share some tweets with you a little bit later. Person of the Year, Zuckerberry Finn. How do you like that? Zuckerberry Finn, is that like Huckleberry Finn? Except Zuckerberry Finn, that's Facebook's CEO. He was in the news a lot. And of course, Facebook was one of those companies that really had a lot of trouble this year in terms of market performance. We saw, in terms of industry sectors, which we'll get into a little bit later though, a major change in the S&P 500, a reclassification of some of these companies into the communications sector. Ticker symbol XLC. So Facebook was among that group. Of course, Netflix also among that group, and Alphabet. And so that was a major change in terms of index classification and categorization. More when we come back. This is the Index Investing Show. I'm Ron DeLegge. Go nowhere.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
Well, the phone lines are open, 844-305-7800 if you'd like to join us. How was your 2018 in terms of investment performance, financial planning, investment planning, retirement planning? What did you do in terms of 2018? Did you move ahead? Did you progress towards your goals? What went right? What went wrong? And what do you think you need to do to improve? These are things that I'm asking you in order to identify what changes you should be making. And of course, you don't need a new year or the start of a new year to make resolutions. It certainly does help, right? Because it gets us to reflect that, hey, it's another new year. We're all going to be 1 year older. And so that, in a sense, is good. But again, we don't need to make resolutions at the beginning of each year because we could make resolutions throughout the year. In other words, a decision, a conscious decision to make positive changes. That doesn't have to wait until a new year to happen. It could happen in the middle of the year. So these are things that I want you to give consideration to. Now, it was legendary investor Sir John Templeton who once quipped that bull markets are born on pessimism, they're grown on skepticism, they mature on optimism, and they die on euphoria. So whatever euphoria was left in stock prices, we could say have been zapped by ongoing international trade wars, rising interest rates, and political upheaval. Moreover, the fast decline in stocks, I think, is a sober reminder of how quickly the mood can change. Whenever the S&P 500 has suffered declines of 10% or greater in a single quarter, which is exactly what happened in the fourth quarter of 2018, if we look at history, it's rebounded very strongly in subsequent quarters. So going back to World War II, stocks were able to nab positive performance almost 74% of the time with an average gain of almost 16% during the next year. Just 3 years, 1973, 2001, and 2002 suffered negative returns during the next year. So that's history. When we have an S&P 500 decline of 10% or greater in a single quarter, which is what we suffered in 2018. So based on history, you might say the odds look pretty good for a rally. And the question then becomes, will it be a sustainable rally? Will it be a head fake? Will it be what they call a bear market rally, where the overall trend is still down, but you have a temporary relief rally where stocks go up? So that's the question. Will it be a head fake? Will it vacuum in more investors and fool them into thinking that this is the bottom? Now, speaking of bottoms, I'm going to quote another great investor of the past, Bernard Baruch, who said only liars manage to always be out during bad times and in during good times. That's so true. Only liars, only fakers, only ones that haven't been keeping track of their trades, right? They only keep track of, or cherry picking, where they say, oh, let me sell you my newsletter. I've picked all of the previous bear markets and bottoms perfectly. My batting average is 100%. If you see any newsletters or any financial analysts that say that, you immediately run the other way. Because, quite frankly, nobody bats 100%. In fact, the only people that bat 100% are the ones, again, that aren't keeping track of every single trade, every single move, every single recommendation, or they're fibbing. They're only cherry picking. They're only keeping track of the good trades while they're shoving all the bad ones underneath the rug. So no one bats 100%. I mean, that's just a common sense kind of factual statement that we all should know. I mean, let's not be gullible here. Let's not deceive ourselves into being utter fools. Utter fools that believe whatever financial rubbish someone tries to sell us. Speaking of fool, on my Twitter feed, Motley Fool is indeed drenched with foolish investing advice. Another example, I think, of counterproductive advice that's sold to the public that tries to get them to gamble and on individual companies for their core portfolio. Let's try to find the next Google. Here's a stock pick. This is going to be the next Amazon.com. And getting investors out of context, out of whack. Now, if you're going to be that type of investor for 2019 and ahead, it's okay to invest in individual stocks, as I've said many times in the past, but do it within the controlled setting, within the context of your non-core investment portfolio, which is much smaller compared to the core. The core is your foundation. That's where your serious money is. That's where the money is where you cannot afford to blow. The money that you're banking on in terms of a future retirement. That's got to be something that's consistent. It's got to be something that outperforms the vast majority of Wall Street managers on a regular basis. It's got to have controlled fees that are low. So that is your core portfolio. That's where the bulk of your money is. So this is the framework that you have for building and managing your investment portfolio. So getting back, though, to 2019 and statistics, the past is the past. Historical performance tells us only that. It doesn't really tell us what the future will be. It gives us an interesting look of what happened in the past, but will 2019 be the year that goes against all the stats where stocks go into bear market or sink deeper into bear market, right? Because by definition, a bear market is a 20% decline from the peak. And by that definition, we are already in a bear market in certain benchmarks and indexes. We certainly a bear market in terms of the small cap indexes, which have gone down greater than 20%. Of course, the NASDAQ, tech heavy, also in that zone. So will we continue to go down even more in 2019? Well, we'll have to just wait and see. But the point is can your investment portfolio perform in any kind of market? See, that's why I think it's so important not just to look ahead and be worried, but also to prepare and to have a multi-dimensional approach, or what they call strategic asset allocation. That can include a multiplicity of strategies, and we'll talk about those strategies on today's show. I think some things that can really help prepare you as we look ahead to 2019, with the expectation that stock returns, stock prices may be flat lower. So that's what we'll get into, a couple of strategies and ideas I think that'll help you as we look ahead to 2019. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here talking the birds and the bees of successful investing. If you'd like to join us, any stocks, ETFs, mutual funds, or other investment ideas you'd like to discuss, we're here. 844-305-7800. At Index Show is my Twitter handle. I'll be right back.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Direction's daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direxion shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.direxioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
If you ever miss our regular radio broadcast, which happens every Sunday from 8 a.m. to 9 a.m. Pacific, you can catch our podcast. It's available at iTunes, also Google Play, as well as indexshow.com. We archive every single broadcast that we do. And when you listen to our podcast or archives, you will see a consistency throughout those episodes, a consistency in investment philosophy, a consistency in approach that you will not see on other media as well as financial programs. You will see in other programming what I call scrambled eggs and sloppy joes. They're all over the place in terms of philosophy. In fact, they don't have a philosophy. Their philosophy towards investment is not well thought out. It's not thoughtful. It's chaotic, and it's reactionary. That's the key difference. What we do on this program is not reactionary. What we do is we take corrective steps. We take steps ahead to prepare for the future. A perfect example of this is what I've been telling you all along, which is a very central difference from this program versus other programs. What I told you all along and continue to teach in my online classes and continue to evangelize on this program is to have and invest with a margin of safety inside your portfolio. Now, what does that mean, margin of safety? Well, I'm just talking about a cushion inside your portfolio that is separated from your investments, that's earmarked for capital preservation, zero volatility, guaranteed income. So we're talking about safety. We're talking about a form of self-insurance. And it's this margin of safety within your portfolio that will help you to get through the difficult times that others suffer through when market conditions deteriorate. Now, margin of safety, by the way, I borrowed this from the great Benjamin Graham, who applied that same concept, margin of safety, to how a person should select individual securities for investment. So it was Graham, of course, he was a child of the Great Depression, also Warren Buffett's mentor, and he talked extensively after getting his butt kicked in the market. He came up with this margin of safety concept where an investor would buy an asset that had such a great valuation, it was just such a bargain that it created this level of safety for the investor. And he called that his margin of safety. And I'm not going to get into all the statistical stats and financial data behind that. You can read that in your own time. But the point here is that Ben Graham's idea of a margin of safety has a wider application. It's not exclusively applicable to how a person goes about selecting individual securities, but in fact has wider application to your entire investment portfolio and how you go about managing your investments. So as we look ahead to 2019, defensive strategies may play a more prominent role in both advisor-managed portfolios as well as self-managed investment portfolios and retirement portfolios. So the idea here is to mute stock market volatility, protect capital, and keep you focused on your long-term goals. That's the objective. Versus panicking, versus being reactionary, versus being emotional, and shifting in and out of cash, right? Which is like the most ridiculous thing a person could ever do, right? Shifting massive amounts of capital, 100% cash and then 100% all equities, and trying to time the market in and out, and the cost, not just from a transaction perspective, but also the emotional toll and craziness that brings into a person's life. You see, having a margin of safety that's adequate and that's suitable and that matches you and that's compatible with your risk capacity, or what they call risk tolerance, right? That will prevent you from having to play that game of, should I be 100% in cash, or should I be in stocks, or should I be in bonds, or should I be in real estate? Which of these should I be in? See, with the DeLegge framework that I've taught you, you don't play those games. They're not necessary. Those are games for the masses. And by the way, it's a losing game because they always get it wrong. And that's a guarantee. The investing masses always get it wrong. And in fact, my colleague and friend Rick Ferry, he had this to say on Twitter. I retweeted it at Index Show. He said, people say the stock market is smarter than any individual. Well, I have my doubts. For months, the Fed has broadcast a 0.25% increase in December, yet the brilliant stock market, and he says brilliant, of course, sarcastically, the brilliant stock market was shocked when it happened. How dumb is that? The Federal Reserve is broadcasting two interest rate hikes or increases in 2019. Believe it. Well, my thought to that was, dumb as the stock market is, and in the short term it can be quite dumb. It looks pretty silly in retrospect, of course. At the time, maybe not so dumb. But when we look at the stock market in retrospect, it does act in the short run very dumb. But it still consistently outfools the fools trying to outguess it. Isn't that dumbfounding? Another fellow on Twitter had this to say, which I think was very good. He said, I think the wisdom of the market is borne out in the long term and not the short term. It was Benjamin Graham who said that the market is a voting machine in the short term and a weighing machine earnings in the long term. That certainly is very, very true. So these are things that we want to help you to shore up your investment strategy, have an adequate cushion. And my philosophy will help you do that. Now, for those of us nearing retirement or already in retirement, what does that mean for you when it comes to margin of safety? Well, think about this. Your investment time horizon has compressed, and it will continue to compress at a much faster rate than somebody who is, let's say, 20 years old, right? So what that means is that any major events or corrections that happen in the market will be, you'll have a much shorter time frame to recover from that versus somebody who is much younger than you. And so what that means then is that you should have a much larger, on a relative basis, of course, if we're comparing a investor that's still saving and growing their money for retirement with years before retirement, you're not in the same situation. You, as a retiree or as a pre-retiree, you are at the point of what they call deaccumulation. That means you're taking out money from your investments. That means that by design, your portfolio, your investment should have a larger margin of safety. Because if there is a major event, a major correction, which there already has been, you are depleting your assets that much faster, not just with the decline, but also by taking out or withdrawing money. And so that could potentially, if you invest the wrong way, if you don't have a large enough cushion, it could cause you to deplete your retirement savings and risk the possibility of outliving your money, having your capital run out. Isn't that a horrible, horrible risk to encounter or fall into? So you avoid that by having an adequate margin of safety, especially those of us that are pre-retirees or already in retirement. 844-305-7800 is the number. We're here. This is the Index Investing Show. I want to talk more about defensive strategies when we come back for 2019. And I'm going to give you a couple ETF ticker symbols that do exactly that. Be here or be nowhere.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
So also on my Twitter feed at Index Show, I've got this. This is another quote from the great Bernard Baruch. He said, "Now is always the hardest time to invest." Isn't that so true? Now is always the hardest time to invest. In fact, we get paralyzed. Some of us have what we call analysis paralysis. So my online class, which I've linked to in that same tweet, will help you to build, grow, and protect your money. It will give you a framework that's robust for building and managing a portfolio of investments. And even if you've got a financial advisor that you've hired to help you do that, I think it's important to take that class because it will help you understand philosophically what your own philosophy towards growing and protecting your money should be. So I've got that on our Twitter feed at Index Show. Also, what are your weak spots? Seek and destroy your retirement portfolio's hidden flaws. And another link to my online class, which is titled How to Fix Hidden Flaws Inside Your Portfolio. Yes, we don't know why our portfolio's gone down more than the market. We don't know why we continue to lose money. We don't know why our investments are more volatile than the rest of the market, or more volatile than our stomachs can handle. We don't know why all of this is happening. Well, that class will help you to identify and fix hidden flaws inside your portfolio. That's on our Twitter feed at Index Show. And you can also, by the way, if you don't use Twitter, just go to our site, indexshow.com, and enroll in our online classes. They're right there. I've got 4. How to fix hidden flaws inside your portfolio. I've got a class for retirement late savers, a rescue plan that will help those of us that have fallen behind or not gotten started yet for saving for retirement to get jump started. Also, the flagship course, Build, Grow, and Protect Your Money, a step-by-step guide, and my latest course, which is titled Profit During Crashing Markets, a step-by-step guide. Yes, you don't have to be an observer. You can be a participant in profiting when market prices decline. Now, you can do this from several different angles, several different perspectives. You can do it by playing defense. Defense, I would define as investing in ETFs that go opposite the market. For example, the ETFs that aim for 100% daily opposite exposure to certain assets would be definitely a good strategy for playing defense. I'll give you some ticker symbols. SPDN, which is the daily S&P 500 Bear 1X shares, aims for 100% daily opposite exposure. Now, this is a great strategy. Instead of trying to say, well, I've got a position in an S&P 500 index fund or ETF, and should I sell it? Should I completely bail? Well, you can keep that position. You don't have to sell it. But you can simply add some insurance, what we call portfolio insurance. That's what I call it. And add a position in something like SPDN, which will hedge that position that you have in the S&P 500 index fund. In other words, if that S&P 500 index fund declines in value, the ETF will, by design, it's designed to increase if market prices go down. And so that's a more balanced approach, I think, towards portfolio management versus saying, well, you got to get completely out or get completely in or shift in and shift out. You don't have to do that. Simply playing some defense and having some hedged positions. Now, you can do this not just with stocks, but also with bonds. Direction Investments has a lineup of what they call 1X. In other words, 100% inverse performing ETFs to various markets, not just stocks. They've got ETFs, for example, that do this with bonds. For example, long-term U.S. Treasuries, TYBS, that ETF aims for 100% daily opposite exposure to that particular market. You've also got CHAD, which has actually been a great performer, which aims for 100% daily opposite performance to Chinese A-shares, which have actually been horrible performers, and that's why CHAD has been such a great performer, because it's designed to give inverse performance. So that's one way you can play defense. You don't not have to, by the way, if you don't feel comfortable with the broader market, invest in the broader market. You can invest, for example, in what we call defensive sectors. For example, utilities, ticker symbol XLU, which pays a pretty good dividend yield, also has delivered pretty steady performance. In 2018, if we look at since the beginning of 2018 to the end, utilities delivered a positive return. It was one of the few industry sectors that managed that feat. XLU closed up about 3.5% for 2018. So that's one strategy, or rather another strategy for playing defense. Also, real estate, ticker symbol XLRE, was a pretty defensive industry sector in 2018. XLRE declined about 1.8%, but don't forget that you're still getting that dividend yield, that steady income. So that's another way to play defense, is to emphasize dividends. Both of those sectors, by the way, do pay pretty good dividends, higher than the S&P 500, broader S&P 500 in terms of yield. That's XLRE, real estate, and utilities, XLU. So that's one strategy. And then, of course, we talked about the inverse performing ETFs in terms of defense. What about if you want to play offense, right? You really want to get aggressive, which is okay to be aggressive with your money. Aggressive if you really have a strong view about the direction of the market. You can express that with leveraged ETFs. And the context for leverage ETFs, as I've taught on this program rather consistently, is that you want to trade, if you're going to do it, leveraged ETFs in your non-core portfolio, and then also you're going to want to do it in sharply trending markets. You do not want to be trading a leveraged ETF in a market that's neutral or in a market that's not moving. So, for example, right now we've had a sharp downturn. That is a good place for those bear market ETFs that use leverage, either 2x or 3x daily leverage. We've seen great performance from those types of ETFs, and that's exactly when they perform the best. Now, just to give you an example of what we've done in terms of trades at etfguide.com, because, of course, I also contribute to ETF Guide's research, and we publish a monthly newsletter. So a couple of trades that we did in December, just to give you an example. Direction Daily Technology Bear, 3X shares, that's ticker symbol TECS. Added that position on December 17th at a price of $27.17. And that particular trade ended with a nice gain. A nice gain of just over 10%. And so that was a really good trade that didn't last very long. We as TECS was going up, we didn't get out as it was rising, but we put in some stop loss order in order to protect our paper profits, and that stop loss order got triggered. But we got out with a gain. So that's just one example of how you can gain and profit when market conditions in certain sectors are declining. And certainly technology has had a wave of volatility, but it's also had a overall downtrend, and TECS, if that continues, should be a good performer. So that's one example. And then one final example is the VIX, which measures S&P 500 volatility. And some of those VIX ETFs, again, these are short-term trading tools that help you to participate on higher volatility. VIXY is another ticker symbol to watch, and another way for playing the market offensively and also to some degree defensively. Well, that does it for another episode of the Index Investing Show. We look ahead to 2019 with confidence. You are going to reach your financial goals. I'm confident of that. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.